Well, Wall Street may be up by 5% so far this year, but investors seem to be spending a lot of time identifying reasons why stocks should pull back. So why isn't everyone on board? We're going to check in now with Larry Shover, Chief Investment Officer at SFG Alternatives, and we still have our guest host, Bob Bauer from Principal Global Investors, up here on the desk with us. Larry, first of all to you, we might be seeing a little bit of nervousness and scepticism behind the present valley, but if you look at the volatility index, it's still pretty low. So what are we looking for? Will we see a pullback or not? What do you think?
Well, I don't think we're going to see a major pullback anytime soon because, to your point, I think people are spending a lot more time being cautious and wondering why we keep rallying instead of justifying this higher prices. Let's keep in mind that the S&P 500 has been trading at about a 13.5, 14 times earnings multiple. That's really the cheap side of history. And when you look at the top-down number of $107 earnings per share, that puts us at about $1,500 for the S&P 500. Now, the multiple is starting to expand a little bit, and people are getting more comfortable with that. So I think it's going to continue. The pain trade is on the upside until more people get on board. So the short answer is I don't see a major pullback anytime soon.
A lot of people say, though, a short-term breather is a good thing when you're seeing an upward trend. You don't want to go up in a straight line. That's concerning. What do you say to that?
Yeah, no, I love that. That's good thinking, and I really think we're seeing a consolidation, a digestion period right now. We're seeing correlations drop to lows that we haven't seen in a very, very long time. Instead of just risk on, risk off, we're seeing certain sectors. People are getting out of internet technology stocks, going into home builders, rails, financials, materials, what have you. And so really the lower correlation and by extension, you're going to see lower volatility is just that. It's a consolidation phase, and we're just trickling up. We're not having these gap rallies.
What about earnings season? You're probably in the week of the biggest week of earnings season this time around. What are you watching in particular?
I'm going to watch what really blew me away last week and the week before, and that's some big companies really started to beat on revenues. When you think of GE and IBM, both of those beat on revenue. We haven't seen that in a long time. We can, they can fix the EPS pretty easily, do things for earnings per share for the revenue side, but for the earnings side, but looking for more beats on the revenue. Last week, or up until last week, I think 66% of all S&P 500s beat on revenue. That's astounding. And so looking for more of the same this week.
Larry, this is Bob Bauer from Iowa, but I'm in Australia for the moment. There's a fair amount of talk around the media about a great migration or the big movement out of bonds and back into stocks. We saw for years money's moved out of equities and into bonds. Do you see that happening anytime soon?
I do see that happening, and maybe, Bob, maybe anytime soon is the right way to put it, because when people start figuring out that these S&P 500 stocks are beating their estimates both on the earnings side and the revenue side, and just think of the risk that's in the bond market right now, I think people will start migrating, especially the retail side. And as you know, Bob, we start to see that the last couple of weeks, a lot more inflows, especially into the mutual fund area.
Yeah, you talk about all these beats, but the bar was set pretty low this time around when it comes to earnings season, wasn't it, Larry?
Yeah, you're exactly right. The bar was set low. However, when you consider the fact of Hurricane Sandy and also in Q3, there was a spike in defense spending and business spending. We didn't see that in Q4. So, yeah, the bar was set low, but I don't think it was set that low considering what we saw in Q3, especially when defense spending, business capital spending, something that did not follow through in the fourth quarter.
Okay, the Fed meeting kicking off, I think, tomorrow your time or today your time. There's not really much in terms of expectations surrounding this. Asset purchase programs are expected to remain in place. Rates should be steady. What are you listening in for?
I think what I'm looking for is just some acknowledgement that global growth is in fact growing. We're seeing the European numbers. The PMI last week was astounding. Just some acknowledgement of that. However, keeping the same thing in place. We're the 6.5, 2.5 number. I don't see any change in that verbiage, but some type of periphery acknowledgement that we are in fact growing and our tail risk has been reduced quite significantly.